I'm Naval Ravikant. For the half of you in the audience that don't know me, you can track me down at Naval, formerly entrepreneur, now co-maintainer of AngelList, which has started earlier this year. For the half of you that do know me, what are you doing here? I think we get enough of each other. I'm going to talk a little bit about the angel investing community and the changes that it's gone through, how that's happened, why that's happened, and what that means also for exits. So kind of dovetailing and segueing into what the panel here is going to discuss. I know you're all here really just to sell your companies, so I'll try and keep it quick. So I'm going to talk about the rise of the angels, and I'm going to say some things that are probably not all that popular. So there's been this long-standing discussion about the venture industry needs to change. People have always been going on and on about venture industry needs to change, or this time is different, this time is different. It's usually turned out not to change. Usually it turns out that only lasts during whatever given bubble people are saying that, and then when the market collapses and everyone goes back to the same old way of doing things. But I'm here to tell you that this time, it is different. The venture industry has already changed. And it changed over the last 18 months. And if you weren't looking, you might have missed it. If you're reading Elad's blog back there, you're completely on top of it. But the venture industry changed. And it changed not actually because the angels rose up. That was actually a misnomer on my part. I was just trying to get attention. It's actually because the entrepreneurs rose up. And they staged a little revolt. And the entrepreneurs rose up because they've gained an enormous amount of leverage over the last couple of years. And at first it was happening very incrementally, and then all of a sudden it happened as a flood. The obvious one now is everything got cheaper. You got Amazon, you have Google, you have these massive platforms that have built up investment that now you can use to get started in Bootstrap. You can use Facebook Connect for identity. You can use your iPhone for deploying on mobile phones. Everything's just gotten a lot cheaper. You can build things incrementally. Before you had to build a whole marketing program, go get a marketing booth, go stand at a conference. Now you can buy users one at a time thanks to Google or Facebook. Or if you're Zynga, you can buy them millions at a time. You can go to an incubator or a combinator, and we know a whole bunch of these, and it seems like there's a new one every month. And these are great because they're sort of unions for entrepreneurs. You're not going to cross a Y Combinator startup because then Paul Graham knows where you live. The startups that we're seeing now are very hit-driven. It's a power law distribution. It always was. The old saw in the venture business was third of your companies lose money, a third bring it back, and a third make you a real return. I don't think the stats kind of line up like that anymore. Now it's probably 8 out of 10 lose money, 1 out of 10 returns the capital, and then 1 out of 10 just goes completely nonlinear. So it's a real power law distribution, which in a way is bad for entrepreneurs because if you're in that 9/10, 90%, you don't necessarily do that well. But it's also good because you get a lot more leverage with your investors because when you walk in the door, they don't know where you fall in. It's very, very hard to predict in advance. Everything is more transparent thanks to conferences and institutions like this. A lot of online stuff, blogs. Again, read Elad's blog if you haven't gotten there yet. There's a lot more transparency, so people know what's going on, much savvier entrepreneurs. And of course, most of what I'm talking about applies at the seed and consumer level. Although it is floating up to the Series A level, it is floating into enterprise software and bleeding out into all other kinds of technology. One of the long-term trends in the technology business is that eventually all hardware turns into software. So even if it starts in and now we're seeing all software goes online, all online goes mobile, so maybe it all ends up mobile. So now that the entrepreneurs gained all this leverage, what do they do with it? Well, they decided to put it to good use, and they demanded what I'll call the Entrepreneur Bill of Rights. It's not really printed anywhere. Maybe we should print it. But it's a combination of things. I think nowadays people are used to much quicker decisions from their investors. They're used to using standardized documents. They're used to controlling the allocation of the round, although in many cases the investors still control the allocation. They're used to making decisions independent, having the investors decide independently, not having these contingent financings where, well, I'll invest if so-and-so invests, and they'll invest if so-and-so invests. They're raising less money and taking on less dilution. They're keeping control of their companies. In some cases, they're even keeping the right to sell. True Ventures did something pretty incredible, which is they removed their M&A blocking veto from term sheets. So you can sell your company without their permission, which I think is going to be standard. It's pretty forward-looking. The entrepreneurs looking for peer relationships from their investors. I don't think many of you enjoy the process of driving down a Sand Hill Road and walking into those glass mahogany offices. And anyway, I'll stop there. They're demanding specific knowledge from their investors. Sort of just the whole general philosophy of I am knowledgeable or I am connected is no longer good enough. And they're asking for their cash up front, no more tranche financings. Although they still float up once in a while. But generally, I think most entrepreneurs are savvy enough these days to resist the tranche financings. So the entrepreneurs are making these demands upon the venture industry, and so that has allowed their revolt here, the rise of the angels, if you will. And venture capital is a business, and it's a business that's subject to attack by startups, and in this case, the super angels and the angels are those startups that are, and the incubators and combinators, and they're bringing new leverage to play. So why is this happening now? Why is it this time is different? Well, there's a lot of money flowing through angel investing right now, as many of you have probably noticed. That's because there's not a lot else you can do with your money these days. There's a lot of small exits that are creating small angels, micro angels, who are investing 10K here, 25K there. Very young angels, you know, early 20s, mid 20s. Makes you feel a little old, actually. Everything's getting consumerized, so everyone thinks that they're an expert in it because they can use the product, they can play with it. There's a very strong M&A market for early exits. It's really an acquisition for hiring market, as our previous speakers were talking about. And then you have kind of all these incubators and AngelList and AngelConf that are educating and creating new angels and providing access to existing angels. So the new financings that are going on, basically what happens is the product usually gets built before you raise money, especially on the consumer side. Those of you building hardware or something more sophisticated may not have that luxury. The rounds are becoming a little more continuous. They're sort of smearing as opposed to getting done in one quick pass or one solid thing. You'll often add on investors 30 days, 60 days, 90 days later. There are sometimes no fixed amounts, no closings, no leads. These are what people famously call party rounds. They can be a lot of fun until the party's over, and then someone's got to clean up. Prices are beginning to float, so you'll see someone taking a note at a certain cap, and then somebody else comes in at a small multiple of that just a month or two later. Board suits are going away, and part of that reason in angel rounds because no one's putting in enough money to really have the incentive to take a board seat or to lead. These can also be bad things, by the way, because when the proverbial stuff hits the fan, who's going to step in and give you that extra capital? Nobody wants to move without everybody else moving, and so you end up with this giant staring contest where everyone's staring each other around the table. Terms are getting very, very standardized, series seed or kind of a standard convertible note. And there's a rational herd mentality going on. Once you get one or two or three investors, you'll suddenly end up oversubscribed. And it's rational because in the public markets, if you go and you buy a stock, and you have some information, you go and you buy a stock, the price of the stock moves. In the private markets, the stock price is much slower to move. So it actually makes sense to sort of view the signal that somebody else has sent with their information and act on it. So basically what's going on at a very high level is that advice, control, and money are being unbundled. This was a classic venture capital bundle, and now I think angel financings are basically a bundling of advice and money. And there are combinators and incubators like YC and so forth, and Techstars, et cetera, who are just advice, and then people like DST and Phoenix are stepping in with just money. So it's a sign of the maturation of the industry. And the internet is making it all possible. So now one of the things that people have talked about that this leads to is there an angel bubble? Is there an investing bubble? And there's some concern that's what's going on. So I'm going to take 2 points of view, and the first one is that there is no bubble. Don't quote me on that. This is a point that I actually owe to Jonathan Abrams, who's sitting in the audience. He made the observation, I think on Twitter originally, that if you kind of add up a lot of these super angel and seed funds and angel investing, they basically add up to one mid to large size VC firm. It's about $500 million to $1 billion. So in the macro sense, it's not a real bubble in that if the bubble pops, there's going to be no Ben Bernanke cranking the printing presses and trying desperately to bail us out, which is too bad. But so it's not that kind of bubble. What's happening instead is that Series A rounds are being replaced by seed rounds. The startups just need a lot less capital, less dilution, less control. The money's getting spread around over a lot more startups. So if you take the same couple of $1 billion that might have gone into angel investing, and now each company needs 1/10 of what it used to 5 or 10 years ago, suddenly you can fund 10 or 20 times as many companies. So it just looks like there are a lot more companies. So you have to kind of watch out for that effect. There's a lot of, one of the consequences, because of the power law outcomes, we're going to see a lot more failures too. So if 10 or 20 times as many companies are getting funded, and if the distribution ratio is shifting so that the winners are going to be even bigger, they're going to be the YouTubes and the MySpaces and not MySpace, Facebooks of the world, Twitter, yeah, dated presentation. Then you're going to see a ton more failures. The number of failures that are going to be visible is going to go up by 10 or 20 or 30 or 50x. But they're going to be tiny failures. They're going to be the two-man shop that opened up, raised a few hundred K, did a little something, and then failed. And as an investor, as long as you're in the next Facebook, you're fine. As an entrepreneur, you have to actually work on your exit strategy and make sure you're one of those people who gets acquired for a team, so you have a safety net underneath. So basically, when I say there's no bubble, what I'm actually saying is there's no macro bubble. There's nothing here that's going to make the headlines. What we have instead is we have many small bubbles. And probably each startup in here represents a small bubble, except for the one that's going to be the next Facebook. You're fine. If anything, you're undervalued. Come talk to me afterwards. So what's going on is that valuations have been going up a lot, and that's really good for all of you. There's rational reasons for it. One rational reason would be if seed really is the new Series A, then we should see a convergence into Series A valuations. Because the capital supply has stayed constant or gone up, but the returns to labor, the leverage that the labor has, the engineers have, has gone up so much, you would expect more of the return allocation to shift towards labor in this case. Not the Karl Marx Das Kapital labor sense, but the happy engineer with their getting back rub sense. Anyone who's trying to hire engineers right now knows what I'm referring to. It's very difficult. One of the reasons why the valuations is going up is also that prices are set on the margin. It doesn't take a whole lot of money to move into a market to change the prices. It's just you see a couple of high-price financings, and then sort of everything moves up. So let's say that the average price moves up for a startup for a seed startup from 3 million to 4 million. That's a 25% increase in the price. That doesn't mean that the total amount of capital at risk has gone up proportionately. It can just be a few small financings down the margin which create that illusion. Anyone who studied the stock market closely knows this. When the total capitalization stock market goes from 15 trillion to 20 trillion, it doesn't mean 5 trillion has actually flowed in the market. So the margin setting of the prices means even a small amount of money coming can make a huge difference. And the money that's coming in right now, a lot of it is from VCs who are declaring seed funds. Venture capitalists wearing hoodies, writing checks. And that's fine. I mean, if seed is a new Series A, they should be doing that. That wasn't a reference. But what it does do is that they're very price insensitive. The VCs are basically buying a first look in the next round. So they're like, yeah, 250K, whatever the price is. They don't care. And the entrepreneurs are taking advantage of that by setting up party rounds, where they sort of go and they find the least price sensitive the least price sensitive investor or the most price insensitive investor, and they sign that person up to a term sheet or to a note, and they go around and get everybody else to match that note. So it's a good way of kind of running an auction at the margin. And there are newcomer angels here. And my only advice to newcomer angels is be price sensitive. It is a truism in the venture business that it doesn't matter what price you pay as long as you got in the right company. But if you know anything about this business, you'll realize how little you actually know. And so you want to be able to place a lot of bets with your limited capital, and the lower the price you pay, the more bets you can place. And one of the side effects of this is that hiring is now becoming basically impossible, because the opportunity cost for a great hacker or a great designer or a good entrepreneur is to basically go start a company. So a lot of people who are on the margin can go start their Facebook app company or something equivalent and get funded. So now that you're one of these small, potentially bubble startups, and time is running out, you start looking for the exits. And that kind of segues into the panel a little bit. So let's talk about what the impact is on the exits and the new exits. So large acquirers, as I think our previous speaker is referring to, are basically just buying engineers. And the price on this ranges, but the market price seems to range from about $1 million per high-quality engineer to about $5 million per high-quality engineer. You approach that 5 price if you're all branded, ex-PayPal people. If Google's doing the purchasing, they seem to be driving the market on the high end. But actually, even a lot of the acquisitions you see that are small, that are happening in the $2 million per engineer price range, are actually higher, because those are acquisitions by private companies with relatively undervalued stock. So if you see, for example, Twitter or any hot startup making an acquisition, very often the people who are being acquired are doing their math in their head of what the stock is really worth. One of the side effects we're seeing is that mid-stage companies, companies that are doing maybe 10, 20, 30 million revenue, pretty hot companies, still fairly far from an exit or an IPO, are going out there and raising rounds just to do small acquisitions for hiring. These are companies that don't need the cash, that are still reasonably far from an exit, but they'll go raise $50 million and they'll go do small acquisitions. So some of these startups are really becoming search firms, where you have a really intelligent recruiter who can pull together a group of people, show what they can do by building something out, show that they have the work ethic, show that they have the drive, bundle it all into one project, and then sort of get acquired / hired. And this is a workaround around the old problem where, as many of you know, a really, really talented person in this business can be worth 5 or 10x what a less talented person is worth. But whenever you put them in a big company, it's sort of all munched up. Like, for example, I don't know how many employees Google has, probably now 60 or 70,000. And probably their issue is that there's 5,000 amazing engineers in there. But good luck identifying which 5,000. Because once you just get that many people, it becomes hard to pull them out. So these startups are becoming search firms that extract the best engineers and prove what they can do, and then they get acquired back for what they're worth. Yes. Right. Yeah, I found that most, but not all, of the small acquisitions that are going on, the startups are smart enough to know that they're going to be locked in for years. The lockup periods are getting much longer. That was actually my next point. One of the more common lockups I've been seeing is a 1, 2, 3, 4 lockup, where you get 10% of your stock the first year, 20% the second. You see how this works, right? So you're there all 4 years. So to some of the companies that I've been talking to, we've just started jokingly referring to it as your sentence, because you're going to serve it out. There is no parole in this sentence, right? So if you know that's going to happen, the good teams have multiple options. As the earlier speakers discussed, you'd be a fool to just go with the first acquirer that comes along. You always line up multiple options. And it usually happens with someone you have a relationship with. So you actually end up optimizing not for the best package or the best price, but you end up optimizing for the place where you know you can stand to work for 4 years and be excited about their product without completely going nuts. And if you have an amazing engineer, as we all know, even an amazing engineer working half as hard as kind of someone who's not very good is still way more productive and better. And I think a lot of the bigger acquirers are willing to take that bet. They're saying, if we just get these people for one big rev of the product, and we see that they're just going to continue working on what they've been working on before, something very similar, even 18 months to get us a new product out the door would be a good thing, because these companies can then throw the marketing and the resources behind it. I'm not saying that's correct. That's the hypothesis. It's a giant experiment. And Google's running it. And I think we're all going to find out. We're all going to look back 2 or 3 years from now and say, oh, the brilliant acquisitions were the big ones, the Groupons, the YouTubes, where they paid up for something that was already kind of done and baked. Or the brilliant acquisitions were the Slides and the Likes and the Jambuls, where they hired these great teams who built them a new product they were able to push out and actually make a huge ROI on. But Google's running that experiment. One interesting thing about these exits is everything is renegotiated at the end. So because a lot of these are happening at below or around the price that the investors paid, or they're happening in private stock where the values are fuzzy, the money can move around very quickly on you. So, for example, an acquirer can put 80% of the consideration in the retention bonus and essentially leave very little for the investors, or 99%. Or another case would be they send it down the cap table and the founders walk away with too much relative to the other engineers. Or the lockups can be negotiated down in exchange for the purchase price being lower, which comes out of the investors. Or the investors might push to dividend out the cash that's sitting in the company. So every one of these exits, these small exits, is extremely custom. And because they're extremely custom, there needs to be a great working relationship between the entrepreneur and the investors. Otherwise, someone is going to get hurt. The classic exits, the one that we actually all hope to have, where they buy us for a product and an attraction, and where you get paid lots more money, those require the obvious things, product and traction, but they also require deep pre-existing relationships with the acquirer. I've almost never seen a company get bought for, call it the $50 to $200 million price range, where the acquirer and the acquiree had been working, usually they've been working together for at least 6 months or more. So moving on. Yeah, there's still not enough exits. Even though the M&A volume is up, the funding and startup volume is up way beyond that. So we're still going to see a tremendous increase in the failure rate. Now let's talk about what may happen that may not be so good. Some of the madness entering the marketplace that is actually happening. It's possibly becoming too easy to start a company. You're seeing a lot of people who are becoming entrepreneurs who really maybe aren't ready for it. One of the clear signs of this is people searching for an idea. There are some people who are generally passionate about just doing a business, and they will stay passionate about whatever business they happen to pick. But most people, if you see someone coming back to you every week with a new idea, they're probably really not cut out to be an entrepreneur in this case. There are, of course, many exceptions to that. As I mentioned earlier, the acquirers are splitting the founders and the investors, so that can end up pretty ugly. Prices can go up very, very quickly in this market. Be wary of that. But you know, even if you fail, this is the new graduate school. What's the big deal? If you fail, saddle up, find another investor, try again. I do have some predictions that are not so positive for the future. Well, this one may be not so bad, but I think a lot more micro angels are on their way. Running AngelList, I see this a lot more, where you have people who have just gotten their companies funded. They seem like they're way too young to be investors, but they manage to get just enough out in a funding round that they become micro investors, and they're putting in 10K or 5K or 20K. And these are actually the most valuable investors sometimes, because to someone who's 24 years old, has built a cool startup, is still working on it, is very entrepreneurial, they can only afford to make 2 or 3 5K or 10K investments. But boy, that's a lot of money for them, and they're going to put a lot of time into it. So there are a lot more micro angels in the way, but I don't necessarily view that as a bad thing. But on the flip side, I do think that we will have some cases of spectacular fraud. Maybe not Bernie Madoff class in the volume, but in the style, where you're going to see a party round done for a couple of $1 million, everyone's in for 100K, and then next morning you wake up and the money's all gone and the entrepreneur's gone, and the office is empty. It's just the way these rounds are getting done, it's too easy to pull that off. So I think we're going to see a reversal of roles, and we will see entrepreneurs exploit investors, which is a new thing in this market, or relatively new. We're also going to see companies skipping venture capital altogether. I've already seen companies doing angel rounds at 100 million pre, when they're very successful, raising $5 to $10 million just from individuals. Finally, a little plug for AngelList. We're a community of 700 plus active investors. There's no bubble there, I promise. It's a free service. If you're out fundraising, you can just put your company out there. You can choose who you want to be exposed to. Actually, at this point, we've gotten probably over 100 companies funded, even though we just launched this year. It's sort of hard to track. You can read about us on Quora or follow us on @AngelList. And it's just a way to get your funding done very quickly with people that you want in the way that you want. And one of the last things that we just added to AngelList recently, which I'm not really pre-announcing because it's not quite done yet, but we've got about a half a dozen M&A corporate types on the list now. And you can choose whether to be exposed to them or not when your startup applies to the list. And that way you can sort of softly also open yourself up for an acquisition before you raise funding. An acquirer would rather look at you at that point anyway. Sort of makes sense. So that's it. Thank you. Any questions? Do we have time for 1 or 2 questions? All right. Back. You. The unknown one over there. Sachin.
I'd love to get your take on that last point where, it seems to me that there's this thing where the acquisitions tend to happen at higher valuations for investors. Do you think that's true?
I think it is true. I don't think it's rational. I think the investors are more likely to, because they're higher net worth individuals and because they own a smaller percentage of the company, they will hold out, and that helps push the acquisition price higher. And I would say that they also have the ability to play bad cop in that scenario. So it's always helpful to say, well, I'd love to sell you to you, but so-and-so won't let me. So it kind of helps set some proof points. The classic example is Sequoia. I think Sequoia has been incredibly helpful to their companies just because they won't take a small outcome. It doesn't move the needle for them. There are many, many, many venture investors who would have let YouTube sell at 1/5 of its valuation, but Sequoia held out. So I think there is value in that. But I think a really steely, strong-willed entrepreneur can get to the same outcome. But it would be a rare and exceptional entrepreneur who could do that.
Let's pause for a second. Questions in it. Are
Your car is being towed. No.
Essentially,
Oh.
the parking lot closes. You got all this people out there. Parking lot closes at 7. However, if you pay by 7, you can stay there till 10. So those of you who are parked in the parking lot associated with this building are going to want to stand and make sure that you have paid ahead of time, or you will not be able to access your car. You will be locked in parking lot overnight. So I'm happy to let you continue taking a few Q&A. I also am happy to take probably like a 10-minute break starting our panel at 7. Those of you with cars, this looks like not many of you, in the downstairs parking lot are going to want to stand and pay for them by 7. Okay, I'll let you do like 5 more minutes of Q&A.
Sure.
10-minute break, and then we'll start panel.
So I think he had his hand up first, then we'll get to you. I would say it varies with a company, but I think whatever Google's intentions are, usually they end up working on a different product. Just because it's a big organization, it's very hard to keep people stable in what they were exactly brought in for. So I think usually what Google does is put them in certain groups, but even there, Google's a very rational acquirer. My guess is people float around. In fact, I know people float around. They kind of end up in the place where they're most needed or most want to be.
Something that you mentioned last week, I think, to the next that focuses too much on going IPO and selling out. And based on your talking about the entrepreneur and maybe
Yeah.
changing, what do you think about entrepreneurs moving forward now, maybe getting a little bit not concerned so much about that there has to be an exit, there has to be an IPO to be successful?
Yeah, I think if you're looking for an exit is a mirage in the desert. If you look directly at it, it disappears. So I think you kind of have to approach it sideways. You sort of have to go about your business, building your business, doing what you want, and then if one shows up, you can evaluate it on its merits. But I agree in that you can't look for an exit, and entrepreneurs who are looking for exits aren't really entrepreneurs. They're sort of tired of their business, or maybe they've just been at it for too long. I think it depends on the stage of the company. Later stage companies can really benefit from representation because they're selling based on numbers. Companies that are looking for a broader range of acquirers, like for example, if you're in the media space and you want to reach the Condé Nasts of the world, then it probably helps to have a representative who knows those people. But if you're looking to sell to Google or Facebook, the last thing you want to do is show up with a banker because they don't want to pay that fee and they're not going to take you seriously. I can't tell you who's done that before, and it's on the whole deal, basically. It's on the retention, and in these small acquisitions, retention tends to be most of it. But I will say I've seen one acquirer do it, but I know every rational acquirer has considered it. 10% of your retention bonus. Basically, most of the package goes in retention. You get 10% the first year, 20% second year. Because they're trying to avoid the case where someone leaves after 2 years or a year. All right, I think that's it. Go save your cars.